Hello, everyone, and welcome to today's webinar. For those of you who do not know me, I'm Joe Salvatore, part of the CCM team here. And for those of you who've joined our webinars in the past, welcome back. I know it has been a while, but doing these is a new way of us reaching out during these trying times right now. And we'll continue to probably do these in the future. So thank you for joining us. So before I hand things over to Randy, just a few things I want to go over. The main thing is that if you do have a question during the webinar, the way that we will do it is Randy will give his whole presentation. You do have the option, if you highlight your mouse, pop the control panel up at the bottom of the video, there should be a Q&A button there. So what you can do is you can bring that up, type in your question throughout any point during the webinar, and then once the presentation's over, Randy will bring me back in and I will read the questions to him and he can answer those. The only other thing to take note of is just know that this webinar is being recorded, so for the people who were not able to attend, we will post it on our website. Everyone who is joining and asking questions, everything is private. Your identity is held. The only people who can see it is me and Randy. So no worries there. So without further ado, I will bring Randy in here. You can give the presentation, and I will be back for the questions. Thank you.
Hello, everyone. Welcome. Today, we're going to be talking about retirement nest egg and your financial portfolio. As we'll be going through the PowerPoint presentations, we got a couple of things you should know. All the securities and the advisory services are offered through Chesapeake Capital Management, and we're registered as an investment advisory firm. A few topics to be discussed today. We'll be talking about 2020 elections, what it means for presidential, senatorial, and House of Representatives. We all will be. Hopefully, everyone's out there voting when the vote time comes. Some of you already have started that, so I thank you for doing that. We're going to be also talking about a market corrections, which we had gone through back in February and March. Some of you may have seen your portfolio have gone down as much as 35 or up to 40% during that time. Most of you have gotten all your money back and then some, or some of you are getting it back and you may be a little short. Depends on type of a risk that you have taken since that time. We also will be talking about a COVID-19. How will the pandemic that we are in continue to impact your retirement planning? And also taxes, we'll be talking about and giving you some tips of reducing or eliminating taxes on your benefits. So where are we now? Well, let's kind of take a look at some of the major economic indicators. So let's talk about the GDP, gross domestic product growth in first quarter, second, third, and the fourth quarter, anticipated fourth quarter. We started out with the 3.1% growth at the beginning of the year, but as soon as the COVID-19 hit, our growth has gone down to 2%. This past quarter that we just ended, it has gone up slightly, and they're anticipating the fourth quarter to be even better than that. In the labor market, which is the employment to population ratio, has gone from 3.6 to 3.7, and it's been pretty steady on the third and anticipated to be the same. And as you can see, the inflation, they were anticipating at 2% at the beginning of the quarter of this year, and they're hoping that you will be under 2% throughout the year. Consumer confidence is starting to go up, which is a good sign, because if you're confident about the economy, you will be out there spending money, which will be good for all of us. And the manufacturing has started to go up as well. So that's all good news. So what we're going to talk about is a couple of things, what we're facing with up front, some of the headwinds, things that we have to worry about. We have to worry about the slowing global growth, higher volatility, acceleration in wages and other business costs, and of course, 2020 elections. What about some of the tailwinds? What's going to be helping us is Federal Reserve is stand on the economy. They're very dovish about the future. And also we're going to talk about the corporate profits, how that's going to help us, housing market, and again, 2020 elections as well. So let's talk about slowing global growth. Let me kind of take you back to that. So slowing global growth. As economies worldwide continue to labor under the coronavirus pandemic, the IMF, who actually lends money to the countries, they have determined that most of the world economy will slow down. As you could imagine what's going on in Europe, they are much more forthcoming when it comes to the coronavirus and how it's affecting their countries versus Asia, where two main countries like China and India, I think that we'd like to know more information about them. They seem like they're back to work. However, apparently there's a lot of resurgence of COVID-19. So we really need to worry about that, how that's going to affect us. Now, looking back to what we had dealt with this past few months in the economy and also the stock market, the reason we're talking about the stock market is all because it's dealing with your retirement plan. Back in July and August, stocks powered through during that time. We have entered a historic territory in the midsummer. August saw a powerful rally. So we got back a lot of the money that we have lost back in February and March. Matter of fact, the NASDAQ composite climbed 9.59% in August, and Dow Jones Industrial Average gained 7.57%, finishing with its best August since 1984, advancing 7.01% to cap the 5-month winning streak. So everything that we have lost, or most of the money we have lost back in February and March, we have gained back by August and September. Now, there are some reservations about the rally because traders are questioning sustainability of the summer economic recovery, whether a full uptick in coronavirus infections might hurt the business and the consumer spending. I think everyone's worried about that. As the winter approaches, we just started our fall season. People tend to get sick. So they're worried about how would COVID-19, in addition to having a flu, would affect our economy and individuals. Now, in addition to that, the acceleration in wages, in order for a lot of these companies to move forward, they had to pay more money to people to do the type of job that they were paying less with in the past. Because you got less people working, some of the people decided not to go to work at all. So the business cost has gone up and their revenues has gone down, especially in the businesses like airlines and restaurants and hotels, obviously. It's really sad to see some of the local restaurants that I am familiar with have started to close down. And I hope, and we all hope, the COVID-19 will be somewhat managed very soon. And we're also going to talk about the 2020 elections. That will certainly affect your retirement and your financial portfolios. Let's talk about the tailwinds. What's going to help us through this trying times? Federal Reserve Jerome Powell, who's the chairman of the Federal Reserve, has a very dovish pivot, which means that he has taken a direction which is different than what he used to do. He feels that our economy is not growing that fast. He doesn't think that inflation will be here soon. So he has taken a position where he will keep the economy going by reducing the borrowing rate at a very low rate. So for more than a century, the Federal Reserve has had two primary monetary policy objectives: one, to manage inflation, and to guide the economy toward the state of maximum employment. Historically, managing inflation has come first. So the news on August 27, only a little over a month ago, when the Fed chairman again announced that the central bank would seek to achieve the inflation that averages 2% over time, rather than proactively adjusting short-term interest rates when inflation approaches that established target. In other words, he would tolerate a little more inflation than he'd had in the past as a trade-off of spurring the economy. So right now, the Fed allowed the major banks to borrow at 0% or up to 0.25% to spur the economy by releasing more money to the economy. Corporate profits. Well, starting this week, we're going to be seeing earnings reports starting to come out from the third quarter. We're certainly will know by next 3 to 4 weeks to see how we have done in the third quarter versus what we anticipate in the fourth quarter or even next year. We feel that corporate profits should be up mostly because the summer certainly spur people to go out and spend more money. And by doing so, our economy grows. By doing so, the corporate profits go up. The housing market, home sales soared as the summer began, and although that momentum tailed off lately, residential resales were up 24.7% in July and another 2.4% in August. New home buying increased by 4.8% for August after a 14.7% of July climb. Housing starts and building permits were both up by 17.9%. In the first month of this quarter, I started to drop off a little bit. We're down about 0.9% right now in this month. And again, we're talking about the 2020 elections. A lot of people ask me, and a lot of people have discussed what it means to have our current president be reelected versus perhaps the new president from the Democratic side will take the office. We certainly don't know which direction we'll go, but let's kind of talk about both. Based on current president's outlook, current president has reduced the tax rate for both the corporate and the personal side versus the new president coming in have said up to certain income level, the taxes will go up next year. So how would that affect you as your retirement planning and also your financial portfolios? Well, one of which is, I'm going to take the back end first. Let's talk about any money that's not in an IRA account. Let's talk about a non-qualified money or brokerage account that you may have with us. Anytime we buy and sell, if there are profits in the short term, the short-term gains will be added to your income in your income tax rate. So if the income tax rate goes up, you will be paying slightly more of the income tax on that money that you have gained. If you're dealing with any qualified money, such as your IRAs or any of your 401ks and 403bs that have rolled into an IRA, anytime we buy and sell, because it's inside of a qualified plan, you do not need to worry about paying any more taxes until the time where you draw the money out and spend it. So in the personal side, for a brokerage account versus the IRA or qualified account, you have to understand how that would affect you. And according to your personal tax rate and tax situations, you need to revisit very soon after the election to figure out what you might need to do. If everything stays the same, the tax rate should stay with unchanged numbers next year in 2021. But based on the president, if he comes through the Democratic side, and if the rates go up, then you may need to adjust some of your thinking prior to 2021. You will have after the election of November 3rd through December 31st to make those adjustments. So 2020 election will be very important to all of us. If you own a business, I'm one of the small business owners. Obviously, we also need to deal with corporate taxes, how they would affect our companies. So some of the forecasts that we have analyzed in 2021 is we feel no matter who's in the office, the market should still started to go up. Maybe it will be down at the beginning of the year, but by end of 2021, the stock market should start to go up still. Right now, there's a lot of talk about the stimulus money that's been pretty much stalemated. I guess it hasn't gone anywhere from the negotiations between the House of Representatives. If you look at who's in charge of the Democratic side, who makes those laws, versus the White House, the negotiation hasn't gone much, even though I think everyone agrees that we will need some type of stimulus again before the year end so that we could help the ones who may be suffering through this coronavirus. We hope the money will be released or at least added to those people who have much needed. But in either case, 2021 will be a better year than 2020. For one of the factors is both the Republican and Democratic side agreed that we need a major infusion in infrastructure money. They are talking about way over $1 billion to do that. And whenever that happens, you're getting the economy going by hiring more people to fix up the roads and bridges and such. So 2020 will be a better year. I am very sad that 2020 has affected negatively to all of us. I know some of you are very upset, even more upset than the other because you're not able to get around. Hopefully this will be over soon. So stay put, have faith, and keep on smiling. And if there are any questions that you have, Joe will be letting me know in a minute, so I'll be answering those for you. Thank you for being with us today. Joe?
All right. So we actually only got one question. The good thing is I think it's a big one here. So definitely while we're going through this one, if you do have any questions that you want to get in before the end here, feel free right now to open up that Q&A box and type those in. So the question here is, should I pull my money out of the market before the election?
Well, that's a real good question. it all depends on what you like to see it happen with your investments. Obviously, if you pull your money out in the market and the market goes up, you will not have any opportunity to make money. Most of my clients, most of the money that I manage, most of you are much more interested in protecting the assets you have. But at the same time, most of you have diversified your portfolio so that not all of your money is in the stock market. So if you were to pull that out, you will not have an opportunity to grow if the market goes up for the rest of the year. We are just getting back. For some of you have gotten all your monies back. Some of you have still are a little shy, maybe 5 to 10% below what you had at the beginning of the year. So I don't recommend you doing that. That's why you hire me to work for you. I do that. Some of you have noticed that you may have 5%, 10%, even up to 25% sitting in cash right now. So we're already sitting there just in case the market goes down. So we could go back in. We're looking for the entry point to go back in to see if we could help you make more money without taking any extra risk. So I wouldn't recommend you taking everything out. However, I work for you. So if you feel that's what you want to do, please give us a call. But I will not be recommending that as a wholesale move by taking everything out of the market. So I want to thank you again for being with us. If you have any more to talk about, please give us a call. You could email me or call me or set up an appointment with us so that I could help you to re-evaluate your personal financial situation.
Hey, Randy.
Yes?
We just had one more question pop in here. I think it's a quick question we can answer before signing off here. It says, do you think that RMDs may be delayed again next year?
Well, obviously, I don't know what's going to be next year. You certainly have helped some of you. If you don't have a need, the money, and because of the RMD required minimum distribution, force you to take the money out whether you need it or not. So for those of you who didn't need the money, you decided not to take the RMD in 2020. 2021, again, I have no idea what's going to be. However, if that's a concern to you, taking the RMD and how that would affect your taxes, please give me a call or set up an appointment with us so that I could go over that in an individual situation. Joe, you have anything else?
Nope, that's everything. So you can sign it off.
Thank you again, folks. I look forward to seeing you in person sometime very soon. I look forward to doing more webinars so that we could give you some updated information as that we get it. So thank you again. Have a wonderful day. Bye-bye.